The emergence of China as a global economic powerhouse profoundly affects Latin American economies. Over the past 2 decades, China has evolved from a distant trading partner to a central player in the economic landscape. Countries in the region supply vital commodities to China, while China has developed into an important trading and financial partner through investments, loans, and currency swaps. As illustrated by the sheer amount of bilateral trade, China has become a key trading partner for many Latin American countries. Between 2000 and 2022, total trade between China and Latin America rose from $12 billion to $310 billion, with an average yearly growth of 15.9%. For comparison, global trade value has increased by only 6% rate per year since 1995, when the World Trade Organization was created. China has consistently been one of the largest trading partners for countries such as Brazil, Chile, and Peru. In South America, China is now the largest trading partner while being second largest in Latin America, behind the United States. The pattern of trade favors commodities from Latin America. Although this increase in trade has benefited the region, countries that export commodities to China may experience reduced demand and lower international prices, affecting their export revenues if China's growth remains subdued over the long term. For example, the decline of the Chinese real estate sector. Once a major economic growth engine, it has seen a sharp decline in investment and new home sales. This downturn led to a decrease in the prices of industrial metals such as copper, which dropped 15% since the end of January 2023. This immediately and profoundly affected metal exporters such as Chile and Peru, exposed as end markets to China. There are concerns that this may be a more permanent trend as China transitions from an investment-driven growth curve to a consumption-driven one. Chinese capital has emerged as a significant source of investment and loans for Latin America. From 2000 to 2004, Chinese investment accounted for 1.44% of total foreign direct investment in the region, increasing to 8.81% from 2020 to 2022. The main recipients were Brazil 47.5%, Argentina 24.5%, and Mexico 21%. Investments favor projects in energy and mining, which account for more than 65% of all Chinese FDI in Latin America. Countries in Latin America with substantial Chinese investment could experience varying effects. A slowdown in China may lead to a reduction in investment levels in the region. While China may continue to support certain infrastructure projects, financial assistance could become less generous. This would affect several areas, but most importantly infrastructure. If the funding flow is diverted from Latin America, countries with unfinished projects could be forced to look for alternative sources of funding. Latin American economies, dependent on both the United States and China for trade and investment, face unique challenges and opportunities. The high interest rates in the United States present a significant hurdle for Latin American economies to cross. The Fed's monetary policy directly impacts capital flows, exchange rates, and inflation, making it challenging for Latin American countries to lower their own interest rates to stimulate domestic growth. The growing importance of China in Latin America is strengthening exports, fostering economic diversification, attracting investment, and promoting economic growth. However, the recent lack of strong growth in the Chinese economy poses significant risks. Latin American countries that depend heavily on commodity exports could be confronted with reduced demand and lower prices, resulting, to some extent, in economic instability. In addition, if the region is too heavily reliant on Chinese investments, it may face market volatility and financial pressures. Latin American countries may reevaluate their international alliances and partnerships based on the evolving dynamics between and within the U.S. and Chinese economies.